Hi, I'm Mal from the Money Study, bringing you another episode in our Take 10 challenge. We're up to number 14. This is all about this thing called an offset account. Now, you may not have any debt anymore, so this whole session could be irrelevant, but it's always not a bad idea to find out how everything works because you might be talking to your children or someone else. So let's go through it all. Straight after the disclaimer, there's the facts, the figures. It's all about information. We're not giving you advice in any of these episodes. So an offset account, effectively all it is, it's where you've got a mortgage, you've got a debt on your home, you've got this mortgage that we're going to pay back over time, but linked to the mortgage is a normal, well, it's a transactional account, a bit like a normal savings account. And any money that sits in that account that is actually tied to that mortgage, it doesn't earn any interest. So you're thinking, well, why would I want a savings account that doesn't give me any interest? The reason being is that the interest that it would is now offsetting. It's offsetting the debt on the other side. So, and it, generally speaking, is what we say 100% offset, meaning that if you've got a debt of 50,000, or let's say $500,000, you've got $20,000 sitting in your offset account. Therefore, your debt is actually the 500,000 minus the 20,000 in your transactional account, meaning you're only paying interest on the loan on $480,000. So basically what this is boiling down to is it's like making advanced payments. It's like putting extra money off your mortgage so that you've actually reduced the debt. So you're still making your normal repayments. So you're making your repayments every month or every fortnight, however you've got the loan set up. But any spare money, you're just pouring it into this offset account as a transactional account. You can just be putting money in, and of course you can be pulling money out. But the more money that's sitting in there at any time, that is indeed reducing the interest on our debt because we're actually reducing the total amount of money that is basically having the interest applied to it. So this gives us a lot of flexibility in a lot of different ways. It could save years off your loan term by having 20, 30, 40, 50, $80,000 sitting in our offset account, meaning that our loan has come down by an equivalent amount of money. Now, this has also got the advantage that normally if you've got a savings account, you might be getting your 3 to 4%. But if your mortgage rate is at 6 or 7%, then your money effectively is earning 6 or 7% by reducing the interest on the debt. Whereas if you had it in a savings account, you're only earning a lower rate. So you're actually getting a higher return on your money. And quite a few of the providers and banks and so forth will let you have more than one offset account against the loan. So you might have 4 offset accounts set up against the loan. And each one of those offset accounts is for a different thing. Could be a bill paying, could be for an emergency fund, which we're going to talk about an emergency fund in an upcoming session. But it could be the money that's there for a rainy day, the holidays. It could be all sorts of reasons why you might want to have your money separated to different accounts. And I think a lot of the providers and banks will indeed offer you more than one offset account. But it's the combined, how much is in all of those offset accounts. If it's all tied to the same loan, how much has that actually reduced the loan by? Now, of course, this not only are you getting a higher interest rate, we've actually got some tax benefits here as well. In the regard that if you have money in a savings account, let's imagine you had $50,000 sitting in a savings account and you're now paying interest 3 or 4% or so on that money. The money that it makes is income and will get added on top of any other income that you are deriving. Hence, you would have to pay tax on it. And of course, the higher income earner you are, the more tax you'd be paying on that savings account. So your meagre 3 or 4% might indeed become, 2% or something like that after the tax has been taken out. But if our money's sitting in an offset account, it's not actually earning us any interest. It's basically just reducing a debt. There's no tax on debt. So effectively what it boils down to is we're not paying any tax on the benefit of actually paying the loan down. So we're not only are we generally speaking getting a higher interest rate, we're also getting rid of the tax that would be payable had the money still sat in a savings account. And another really very handy reason for having an offset account is just imagine you've got your first home and you're in your 30s and you've got yourself a two-bed unit or something, and obviously realise that this is not going to be a home forever. We really want to move into a bigger home sooner than later. And we've got this home, but we're thinking, look, it's actually not a bad little place. Could be really good as an investment property. So you're thinking, okay, what we'll do here is we'll save up some money, and then what we'll do is we'll have some money saved up, and we can buy our new home by keeping the old one as an investment property. Now, the issue here is all about tax and what is the purpose of debt, and so it goes on. In the regard that if you're planning to turn the house you live in into an investment property, then what you do is you save cash in the offset account for your new property. So the money that you're saving is reducing the debt on the house that you are currently living in. So the money's just, so you're reducing the debt, you're reducing the interest you have to pay, and you're actually saving for your new home. And then when you finally move into your new home, you just pull all the money out of the offset account and use that on your new home to reduce the size of your mortgage on your new home. And because you've removed the offset from the old debt and the old house, your loan effectively has gone back up again, and hence that debt, because it's an investment property, is a tax deduction. So whereas if you actually pay the debt down and you didn't have an offset account and you just paid off your old house, if you then borrowed money from that property to buy your new house, the purpose of the debt is to buy the new house. There is no tax deduction. So if you're even contemplating this when you're first buying your first house, have a chat to your mortgage broker or bank suggesting this might be something you want to do in the future to ensure that the loan has got the facility to do what you're trying to do. You might need to listen to that a couple of times before it sinks in, but it can be indeed an excellent idea for people who are considering their first house or their second house to become an investment property in the future. Now, the downside of an offset account is obviously anything that's got more bells and whistles. The fees are higher. And in some cases, I've seen them, where they charge you an extra $500 a year to have an offset account. So you need to make sure that you've put enough money into the offset account to get all the tax benefits and the higher interest rates to offset the fact that you're now paying an extra $500 in fees. Not much point, paying $500 a year if you're only going to put $1,000 into your offset account. The benefits just wouldn't be there. Okay. So when you're talking about setting up a loan, have a chat to find out whether you can indeed get more than one offset account if you need more than one. And be careful that they're not very common these days, but there were offset accounts that are not 100% offsetting, meaning that if you've got money in an offset account, it's reducing the interest on your mortgage by 50% or 80% or something like that. It's not actually reducing the interest on the debt at 100%. So just make sure when I say it's an offset, is it 100% offset that we're talking about? Okay. And I suppose the only other issue is that because it sort of sits in a transactional account, and when you log into your bank platform, you'll see this account with this money sitting in it, and because it's positive money rather than negative money, it's very tempting to say, oh, well, actually, gosh, we've got 40 grand in our offset account. How about a holiday, or buying a new car? And it's we've effectively now borrowing all that money, taking that money back out again, effectively all the hard work you've done to get it in there. I mean, if that's what you're using it for, fine. But just don't get tempted every time it gets up to a reasonable level where it's finally starting to do you some good to then basically just pull it out for your next new toy. So quite a useful feature, very flexible and pretty common these days with loans, but just be careful of the extra fees. We'll join you again in another episode.